Okay, welcome to today's webinar. I really appreciate your time, and hopefully you find this of value. You would have seen in the invite to this webinar, the art of asset allocation. You would have seen a statistic, and the specific one I'm referring to is that 90% of returns have been shown, and there are different studies. Some will have 75, some will have 70, but the point is there's a large percentage of your returns that rely on your asset allocation. Obviously, the definition of asset allocation is quite wide, and that's part of what we're going to chat about today. But just understand that that's where it comes from. A lot of times clients have a conversation with their financial advisor, their wealth manager, their potentially fund managers, and they never really know or understand exactly what's behind the mix in terms of the asset allocation. So there's a great fund or a portfolio or whatever it may be, the instrument that you're going to invest in, but there's a whole world underneath it that is dictated by the asset allocation. And that's what I want to get to today. And I decided to choose the word art, the art of an asset allocation, because that's what it is. It is a bit of an art form. Some people will love your artwork, and the next person that walks into the room will hate that exact same piece of art. So we need to understand that there are quite a number of different opinions on this. But I think the one opinion that is universal is the fact that when you look at asset allocation, it is hugely important. There are a number of factors that you need to consider when you look at asset allocation, and those we're going to go through today. But once you've decided on that asset allocation, it needs to be a winning strategy. And I think there are one or two ways that we'll also briefly discuss today that we can look at an asset allocation of any portfolio or fund or whatever it may be that makes it successful. Okay, so let's jump into it. You know, hopefully who we are. I think that's why you're here. Why should you listen to us? Actions speak louder than words. These are some of the awards we've won over the last kind of 2 years. We've been at the top of the pile for many years. This is just the last 2 years. We're very proud of it. You'll see these awards are going to come out again in probably 2 or 3 months' time. You will receive emails and communication from us to vote for us again, and hopefully we've done a better job than last year and previous years. So, thank you for supporting us if you're one of our clients. What do we do? A number of things. Today, we're talking about wealth management, and more about that in the next slide. But we do, those services you see on the left there. On the right, you'll see a couple of names you might have recognized in the industry. Those are some of our service and product providers. It's not an exhaustive list. There are others, but we want to give each client the best of breed in terms of a solution for them, and therefore we need to use different products and service providers to give you that mix. And those are some of them that you can see there. Next is then just quickly the intergenerational wealth series, building intergenerational wealth. That's kind of this series that I'm doing with you guys today. Hopefully a lot of you have returned from the first two we've done in this series. The first one was Get Your Will in Order, and it's all about how important your will is and the cornerstone of any financial wealth, whatever plan you want to estate planning, we can't have that conversation without your will being in order. Secondly, estate liquidity. It's kind of the silent killer of an estate. Many people don't take into account the liquidity portion of it. Many estates have enough money, so they're solvent, but they're not always liquid. And there's a whole webinar on that. You would have seen, if you attended the previous ones, we follow these webinars up with an email to just tell you it is on our YouTube site. So if you missed out or you want to check on one or two things that we've said, we are loading them on the YouTube site. Not all of the webinars we do, but this series, this building intergenerational wealth series, will definitely be on there. So you'll see all 7 once we've run through them. It's roughly once a month that I do these. So we're at number 3 there, as you can see, the art of asset allocation today. I'm moving on to, and I do refer to active versus passive in this presentation or webinar as well, but I delve a little bit deeper in the next webinar with a couple of important points. So you'll see me highlighting some of the points at a very high level today. And I'll mention it again, then just know that there are a webinar fully dedicated to active versus passive. Then the great retirement annuity debate, is it the right thing to do, retirement annuity or non-retirement annuity? Do we, is it better to save in our after-tax, with our after-tax earnings or monies or salaries? And we explore that debate. You can see number 4 and 5 clearly talks about debate. So it's the jury's out. We obviously have very firm opinions in how we see the world, but it is a debate, and obviously we don't say we 100% correct, but you decide once you've heard the arguments. Then all about offshore, I think very topical these days. And then lastly in line is the structuring part of it, which I think is important. Sorry, and that will cover local and offshore. And that's the series. So kind of 7 installments. We are installment number 3 today. So let's dig into it. On the agenda, what am I trying to do? So today is obviously the art of asset allocation. So I'm trying to break down asset allocation, what it means, how we think, what the world out there, the financial profession kind of consider when they look at asset allocation. And I think it's important for me or for us as financial professionals to share with you what we think of when it comes to asset allocation. It's not always kind of top of mind or spoken about, at least. And there may be various reasons, which I'm not going into for that conversation. But when you sit in front of whoever that may be, if it's me or any financial planner, wealth manager, fund manager, doesn't matter who you sit in front of, I think it is important for you to at least have the ammunition, the knowledge, to understand what this conversation is about and to ask some pertinent questions. And you'll pick up on a lot of pertinent questions as we go through this webinar that you need to that you need to have and to ask, and to make sure you understand when you invest in any instrument, funds, portfolios, whatever. Okay, so on the agenda, we first need to set a base, obviously. So I'm going to chat through a number of technical considerations. I think those are important for everybody to understand. I may bore 1 or 2 of the participants. They may know this, may be able to reiterate it in their sleep. But I want to just get everybody on the same page in terms of the technical or the base knowledge aspect. Then I'm going to go through asset allocation strategies. We're going to talk about investment styles, size, matters, pun intended, and we're going to chat about that one, active versus passive quickly, diversification, and then we're going to end up with costs. Okay, so on the technical consideration side, let's start with asset allocation. And what does it mean? What is a asset allocation? And we usually talk about the fact that the reason why asset allocation is so important is because we want to diversify. All right, that old adage, we don't want all our eggs in one basket. If you drop the basket, all the eggs break. So that's the point. And usually when we think of it, we think about it in terms of asset classes. So the third bullet point you see there on the asset allocation. How the obvious ones, the ones that we all know, we hear it is like, for example, locally is the JSE. Everybody knows the JSE. That's the equity market. So that's one of the asset classes. We have the bond market, property. We have lots of alternative investments and themes coming through the cash or near cash instruments, etc., etc. So how your portfolio is built up out of all those components, that is the typical way we see asset allocation. And then I'm going to go through them now, but there are different reasons why we may overweight equities or underweight equities. But that's just at a kind of a high level. There are other considerations in terms of asset allocation to get this diversification that we kind of need. The first one is country. So obviously, and you've heard this in probably many presentations or webinars, or you've read it somewhere, in articles. We're literally a drop in the ocean from a financial, from a GDP perspective, from a financial market perspective. There's a massive world out there, and if you have all your investments in South Africa, there may be some opportunities that you missed out on. So one of the ways to get an asset allocation or diversification through it is to invest in different countries. Obviously, there are regions as well, classes we spoke about, sectors like, for example, subsectors like property as residential and commercial and etc. There are different subsectors to any asset class that we need to understand as well. So just going into asset allocation a little bit, just to get everybody on the same page in what I'm talking about here, I've gone and borrowed this from Old Mutual. I like this one because in our industry it's fairly well known, and Old Mutual colloquially terms it the Smartybox, and you can see why. It looks like a box of Smarties. Therefore, we look at this and just the basic gist of it, and let's just start here. Hopefully you can see my mouse here on the left hand side of the screen. Let's start with 2006 February. There are basically 5 sectors that they look at here. Firstly, real estate, then equity, foreign equity, SA bonds, SA cash. Okay, so those are the 5 sectors they look at. They throw in South African inflation just as a kind of a measure, just for you to kind of gauge where it's lying at any given point in time. And then they have this one that I skipped over that is called diversified. So all that diversified means is 20% of the 5. So equally weighted the 5 sectors, and then you kind of get an average for that period. Before we look into what we can see here, I just wanted to mention, you'll see here the last one here is February 2020. I've obviously done this presentation before, and this is over a year old. So you may ask, why Feb 2020? We would love to see what happened, COVID and from COVID times, which was kind of a month later, all the way up to today. And I agree with that. I think it's important. But for a general conversation or webinar around, asset allocation and classes, and I think the noise that the last 12 to 15 months brought into the market And what we're going to focus on is probably going to divert our attention from the long-term picture that I want to create here. So I've decided not to refresh this slide. I've kept it 1 year old, and ironically, I did this presentation somewhere 5-6 months into lockdown as well, into our COVID reality as well, and I also chose not to refresh it at that point in time, because then we were miles down from previous levels. Now we are sitting at record highs. But anyway, that's why. If you're wondering, I just want us to have a look at this in isolation. So let's go through it. You can see how asset classes jump up and down during this. Therefore, let's just go foreign equity, because everybody's banging the foreign equity drum the last couple of years for very good reason. Look at the 5-year return foreign equity, top of the pile, 10%. 10 years, top of the pile. 15 years, top of the pile. All right, so you would have done very well over the 5 to 10 years. Now, a big component of that is the weakening of our rand-dollar exchange rate, and and the implications thereof. And I don't want to drill too deep into it, but understand that underpinning these numbers, these yearly annualized numbers, so that 10% is the interest rate differential that needs to hold over a longer period of time. What is it? It's just the difference, just to make it kind of simple. It's the difference between the inflation rate of our country, let's say, South Africa, and let's say the US, which is roughly at the moment, let's say just below 1%, and we at, depending on which one you believe, but that's a completely different conversation, real inflation versus published inflation. But let's just go with published, and I think we're roughly in the region of 3.5 to 4, depending on when you look at it. So there's a 2.5% difference between the inflation rates. Therefore, the real interest rate, so this interest rate differential between the countries, should hold. All that means is, in the economic world, that for the world economy to stay in balance, the rand needs to weaken by that interest rate differential, or inflation rate differential, if I can use the term for now, needs to weaken by that amount over a certain period of, or over a longer period of time per annum. So I would say, and now kind of we are 2.5%, but our interest rate differential with the US pre-COVID was much wider. We're talking 4-5% in real terms. So I would say almost half of this return here is probably rand dollar weakening due to the interest rate differential, which is an economic principle. So you can do the calculation yourself, go back, 20 years, 2001, check what the rand dollar exchange rate was then, see what the rand dollar exchange rate is today, and just do the little time value of money calculation to see what that is annualized, and you'll see it's roughly 4, 5, 6%. Obviously, we're sitting on one of the most volatile currencies in the world. Therefore, we do see these big swings, and that's entirely conversation on its own. Why is it so volatile? But the point is, we do sit on one of the most volatile currencies. So if you go back a year or forward a year, you might rise it up over a longer term. It might rise up to 6% per annum, or may drop to 4%, or whatever the case may be. But the point is, you have this weakening, this constant weakening over time. And now I haven't even thrown in all the socio-political risks that some market commentators are telling you about out there. Nonetheless, sorry, I digressed slightly, but the point is, foreign equity has been doing well, and we know why. SA cash was obviously locally, our equity markets didn't do so well. Real estate really did badly during this period. You can see 20% down. So we really looked for returns and alpha, which we'll get to now, offshore. But this is what the mix looked like. So let's bring it all the way back to asset allocation. for me to tell you, or for anybody to tell you, which one is going to be top of the pile this year, and be able to be correct or guess it correctly year after year after year, or even month after month after month, because as you know, markets, as we've seen in just the past couple of days, how markets can fly down, up and down easily. And I'm talking about equity markets now. So we need to understand that to guess correctly, which one we're going to be in at any given point in time, and is now the right time to get in, is probably going to be hard to impossible. And anybody that has it nailed perfectly, that can choose one equity class and write it up and down perfectly, if that person exists, they won't sit and chat to you. They probably own enough assets to buy a couple of Mediterranean islands and just sip on mojitos all day long with their expensive mega yachts. Anyway, point is, understand that we have to diversify across these asset classes, and that's one way of diversifying in terms of asset allocation. Let's drill a little bit deeper. So that was all SA equity. So everything you saw on the previous screen in terms of the Smartybox, and again, borrowed from Momentum here. Sorry, not Momentum, Old Mutual here. And this is about roughly 15 months old. The equity portion is the same as this previous slide, that Smartybox, right? So everything you see here in terms of the SA equity, it's kind of the, what's that, maroon, pinky, purpley, and then property, bonds, etc. as we go down. What I just want you to see here is, for example, let's start with gold. Gold over the last 10 years and SA equity over the last 10 years gave you exactly the same returns, interestingly enough. Global equity, we know, is top of the pile over this period of time. And so you can go on, through all of these. But the point is, what I'm trying to say to you, over a longer period of time, there are certain themes that we can, or certain given returns that we can start assuming in these markets, and we can, especially over the longer term, we can allocate in terms of our asset allocation across these for those periods of time. Little bit, let's zoom then only on SA equities. So you'll see here, oops, sorry. SA equities, let's zoom in only on SA equities, and these are real returns over this period of time. So we started, 1924, but you can see there's some 70% return months, years, and then there's minus 40. I think 2008 we probably all know. But the interesting part is, look after 2008, all the gray ones here, 2009, 10, 11, 12, 13. Look at the strong returns we've seen post that event. This is a bell curve, but the point is here to just understand that we have a bit of a mixed bag, but roughly when we look over the longer term, we're somewhere here between call it 0 and 20% in terms of its median or its average. So that's a little bit in terms of asset allocation sectors, in terms of the classes or the sectors that we used to. We're going to go into a little bit of countries and other ways and styles, etc. But just to understand that. The other thing I just want everybody to know as again, the technical consideration is these two concepts. First is top down, and the second is bottom up. So top down is kind of this bird's eye 1,000-foot view, looking down, and we look at all the macro factors. If we look at South Africa, what are the rand what are the forces driving the rand dollar, commodity cycles, super cycles, all those discussions, socio-political problems that may or may not manifest in the financial market. Are people investing, due to that, or withdrawing due to that, for example? Okay, so those are all 1,000-foot kind of high level. Next one is bottom up. So whatever the instrument is, let's just make it easy and say it's an equity, and let's say it's a SASL or an APSL, something we all know, is bottom up. So we look at the intrinsic value of the company itself, if we talk about companies specifically now, and we kind of value that, and we try and figure out, is it undervalued or competitively valued or overvalued, and do we want to get involved in it from that perspective? So those are the two big themes, and obviously you get the whole gambit in between the two. But you also need to understand, when you look at an instrument to invest in, what is the approach, and usually, especially on the fund side, you will be able to see that in the commentary, in the fund commentary, and the explanation around the fund. Holding period is another important one, and we need to understand that when we talk about asset allocation, it's very important to understand that the holding period and the time of any investment that we make, the time period, so whether it's a 1, 3, 5, 10, 25 years, 30 years, if you're talking about retirement annuities, and you're in your 20s or 30s, there is a long investable time frame or holding period, and the length of that holding period dictates what we can, how aggressive we can go into it. We've seen that equities and foreign equity already, for example, as an asset class, perform very well. However, you've seen it swing around. Foreign equity, let's just go back just to kind of refresh your memory. Look at foreign equity, up 2 years, and then kind of middle of the road, and there we worst of it, and then 1 year prior to that we're best again, and you see what I'm trying to get to is this volatility over a shorter term needs to be understood when you are in terms of your holding period. So just to illustrate that to you, I chose the SA equities. Again, that same time frame, just to show you. So over any given 5-year period, we have the worst 1 year return was minus 14%. And this is if we take all roughly 100 years, okay, just short of 100. So there would be a year that you encounter, or within this 5-year period, that you're going to have a negative return, and you need to understand that. And if we take that to 1 year, it can be even worse. We saw 2008 at, what was it, minus 30-40%. So understand the short-term volatility needs to be matched to your holding period. You can't go equities if you need the money in a year's time. Who knows what's going to happen over a short period of time. You can, by luck, time it right and get roughly a 31% increase. But the point is, there's over a short term, there's this massive volatility between the two from a holding period perspective. A little bit longer, 10 years, you can see that flattens the difference between the up and the downside. 15 years, even lower, and so we get to a little bit more normality the longer the time frame. And this is SA equities, obviously one of the most volatile asset classes that you can get involved in. From a local perspective, understand the holding period return impact on how we decide on your asset allocation in the end. Next then is a CISA, and all that a CISA is it's guidelines given to our industry when we look at different risk profiles for clients. What is a risk profile? It's for a client to tell me how, or anybody that gives advice really, to tell us how the risk versus return, how much of that you can stomach. So that volatility that I showed you in one of the previous slides in terms of holding period, for example, needs to be understood. So if you understand that, you have a longer time frame, for example, you have an appetite for risk, etc., then I can classify you as a aggressive client. If you don't like that at all, you want to see stable, no negative years, etc., then you know more a conservative type of client. These guidelines kind of give me an idea of what your asset allocations will look like from a regulatory perspective, at least. So if you're aggressive, I can go equity and foreign equity fairly aggressively, and if you're moderate or even conservative, then I'm going to probably give you very little of the volatile stuff. So your local and foreign equity is probably going to be 10 or 20% of your portfolio. And therefore, we need to adhere to those guidelines in certain instances. I see I have a question here. Do these real returns include dividends reinvested? Mostly yes. It just depends on which slide we're looking at, but 9 out of 10 times yes, the dividends would be reinvested on these numbers. Correlations, but if you need more specific info around that, any of these returns, send me an email or phone me, and I can give you something more real in terms of if you need more technical information. Okay, in terms of the next one then is correlations, and I think it's often overlooked, the importance of a correlation. So what does correlation mean? It means when the entire market drops due to COVID-19 in March of last year, do everything you own, do they all drop to the same magnitude? If they do, or something comes out, stimulus package gets announced in America, US markets jump 5% and everything else jumps 5%, that jumps 5% with it, those are correlated assets or instruments. Obviously, we would like instruments to, in their own right, be best of breed. Whether that's assets, funds, whatever, equities, funds, whatever we're looking at. We want them to be best of breed in their own right. So I want to choose them because they're going to grow well or perform well for you as a client over whatever the period of time is, in their own right. I don't want them to grow because the US, only because the US, announced stimulus. Because that's just correlation. Then it doesn't help. You don't get that diversification benefit. So when we look at asset allocation, understand that correlation between whatever we put in there is also very important. And the more uncorrelated instruments we can get into, let's say, a portfolio, the better, because they will then grow. Each one of them will grow on their own merit, and not because of this kind of rising tide that lifts or lowers, or rising or lowering tide that moves the markets. Obviously, sometimes it's very hard to get away from it from highly correlated underlying instruments. If we talk about a equity portfolio, that benchmarks, the benchmark is the top 40 on the JSE. It's going to be hard to get away from something that has underlying instruments that has a lot of correlation between one another. But just understand that it is an important consideration that you need to remember. Sorry. Okay. Lastly, I think this is an oldie, and most people will know it, but just make sure you understand the difference between alpha and beta. So beta is market-related returns. So when we say the JSE has the top 40 index has performed at 5% for the year, that's the beta. That's the market performance. Anybody that manages your money is trying to outperform that beta. So the outperformance of whatever that number is, the beta growth, the market growth, the outperformance of it is called alpha, and that's what we're trying to achieve. We want to give you alpha, market beating performance, and that's kind of the holy grail. Okay. I think that's enough for technical considerations. Let's move on to asset allocation strategies. Another important point is what you need to understand, and I always take one fairly big asset manager, not one of the kind of top four, but big in South Africa. And when I give you this example. So we get strategic asset allocation, tactical asset allocation, dynamic asset allocation. Dynamic is just a bit of a mix between strategic and tactical. There are, of course, others as well, but these are kind of the main, themes in terms of asset allocation strategies. So what is strategic asset allocation? I run a model, and I have a whatever it may be, a balanced fund or a pure equity offshore fund, whatever, it doesn't matter. I have a model where I decide what asset allocation I'm going to use. So let's just make my life easy and say we're going to go 50% equity and 50% property. This model of mine, for whatever reason, spat out 50% equity, 50% property, just to make my life a little bit easier. That's my model. Okay, so every model looks a little bit differently. There's subclasses, as I showed you earlier, classes, subclasses, regions, countries, etc. Okay, depending on what you're looking at. Point is, there is a model that gives me a strategic asset allocation. What we put in that model and how we run it and back tested it, that gives us a strategic asset allocation. And just for now, let's assume that's 50% equity, 50% property. So once we have that strategic asset allocation, in theory at least, we can't touch it. So if it's a pure strategic asset allocation, if it's a fund, let's talk about local funds, equity funds, and if that's a pure strategic asset allocation, I cannot change the 50% as allocation that I give to equities or properties. I can potentially change what's underlying. I don't like this property company anymore. Let's change it to this property company. So that I can change, but I can't make the asset allocation. Remember, we said way up front, and probably why you click through to listen today, that 70, 80, 90% of your return is asset allocation driven. So if I got it right, it almost doesn't matter, or there's a very small reasoning behind it, and this is a different and a shaky ground that I'm talking about now. It almost doesn't matter what I was putting underneath it, but let's leave that conversation for a different time. The point is that 70, 80, 90% of my performance is due to this strategic asset allocation. Now, some fund managers have the ability to change that, and they call it tactical asset allocation. So tactical asset allocation in its purest form, so is I can do almost whatever I want to. I like property for this week, so let's go property. Next week I like equity, then let's go and look for some offshore bonds or whatever. The point is, tactically I can maneuver and change however I want. What you 9 out of 10 times will see in the industry is a little bit of a mix. So there's a bit of a dynamic asset allocation where you can move it slightly. So you have a strategic asset allocation, but you can move either way slightly. So my example, 50% equity, 50% property, potentially I can, for whatever reason, believe property is now, red hot. I need to get my client's money into property, and then tactically, I can decide to overweight property and underweight equity. And I take property, let's say, to 60%, and I pull back on my equity allocation to 40%. So that's a tactical, typically a shorter term decision. It's not a long-term decision. I'm probably not going to have it for the next 20 years like that, or 10 years, whatever. It's usually a couple of months to a year or two. So it's a short time frame that we tactically change what the asset allocation looks at. Why am I talking so much about this? Very important. So this big asset manager that I referred to chose a couple of years ago to exclude NASPers out of the normal equity fund. And if you followed NASPers at all, like we have, or I have, I usually tell clients when we chat about it I think it was 2008, I can remember really robust debates in our dealing room to say, will NASPers break through 300 Rand? Now, today you may or may not know NASPers split, process out of the stable, but if you put the two back together to kind of give you a real value of what NASPers was back then versus what it is back now, or what it is now, we're at roughly 5,000 Rand. So 12 years ago, 300 Rand up to now, roughly 5,000. It's a massive increase over not too long a period of time. So if you left out NASPers as an asset manager or a fund manager, and you track the JSE top 40, and if you go and look how much NASPers pulled up our local exchange in terms of its average performance, due to it being such a big weighting in our exchange, you will realize that the NASPers effect was massive, especially over the last couple of years, when basically, not basically everything, but a lot of the other counters didn't do so well. So that fund manager tactical asset allocation, tactically chose to underweight NASPers. Well, not just underweight, they completely took NASPers out of their funds for probably fairly good reasons. I can't fault their reasoning too much, but they decided to move away from it. But their benchmark stayed the JSE top 40. Now you can imagine the big driving force behind the returns, however dismal it may have been in one or two of the last couple of years, has been NASPers. So if you've taken out NASPers, you would have ended up at the bottom of the pile. The bottom quartile, the lowest 25% of performance, that's where asset managers never want to be. But they were bottom quartile for 2-3 years, and it really hurt the business from that perspective, at least. The point is, and I'm not trying to diss them, anybody can make a mistake at given points in time. Point is, can you, or do you understand that when you invest in a fund or in a portfolio, whatever the underlying instruments are that you choose, do you understand what an impact a strategic versus a tactical or a dynamic asset allocation may or may not have? Make sure you understand that risk in this sphere as well. All right, the next one then is size matters. And what do I mean by size matters? And I always, it sounds like I'm dissing the big boys. I'm not, because there are certain of their funds that are really good still that I do use when allocating clients' money. So that's not the point here. But I'm just trying to illustrate to you to just take those those covers off your eyes and make sure that you understand that there's an entire world out there that we have to look at. And when I talk about size matters, I usually use a couple of examples. You land in Cape Town on Joburg Airport, and that corridor that you walk down to get to your bags. Usually the entire side is covered with some company. Those are the big boys. Or you drive in Sandton and you see these big billboards. Those are the big boys. Or you watch any sport halftime, and the next 4 minutes you listen to an ad from the. Those are the big boys. And we typically and that's, and I'm not saying it's wrong. Don't get me, don't misunderstand my message. I'm not saying don't consider the big boys. Definitely consider the big boys, but understand, just because you see the big boys on TV at the airport and when you drive, those are not the only options you have. And I'll try and illustrate it with the following couple of slides. What I've done here is over a 6-month period. Let me just stop here. You're going to see a bunch of names of fund managers here now. This will be sent to you. You're going to have it on YouTube as well. Don't look at all the names and try and write them down or remember them. I'll even send me an email right now, and 20 minutes after this presentation, you can have this in your inbox. Don't get stuck in the names now. Listen to the point I'm trying to make. These guys, over a 6-month period, were the top quartile performance in the general equity category. I did it again over 1 year period. This is about a year old in terms of the slide. I didn't include an updated slide. Again, because I don't want you to focus on the companies, I want you to focus on the message. Again, 3 years, those are the top quartile performance, and 5 years, those are the top quartile performance. Then I went and said to myself, let's take out the ones that only appear in my 4 time frames here once. And those are the ones in red. So they only appear once. Let's throw them out. What does the table look like now? And let's go and throw out the ones that's twice. And what does the table look like now? And then I wanted to go and say, all right, so this is the guys that appear 3 or 4 times in my time frames, 3, 5, 1, 3, 5, and 6 months, years and 6 months. Now let's go and throw the ones out that's only 3 years. And then I went and looked at this one, for example, and I'm like, you drop out over a 1 year period, but you're back in over a 6-month period, would be unfair of me to drop you out. Methodical, this specific fund didn't exist 5 years ago. It was just outside of the 5 year. It's been really doing well all the way through. So would it be fair to drop it out just because it wasn't in the 5? And I said kind of no. And then the Signa Active Equity, again, to be 5, 3, and 1 years and then just drop out over a 6-month period, I thought, nah, that's unfair. So I decided to stop here. So you can see 1, 2, 3, 6, 9, 10. There's 10 funds. Let's just go over 3 years because that's where they all are. So there are 10 funds. Have you seen any of these on the billboards or halftime at your favorite sport event or when walking down the corridor at the airport? Probably not. So all that I'm saying, I'm not saying never look at the big boys or the big sized asset managers. Just understand that you can look a little bit wider and make sure that when you consider funds, and this is just equity, general equity funds. We have many different categories, but this is just general equity. Just understand that in terms of general equity, there are very good managers out there. Please make sure you look at them. Which then brings me to the other points, active versus passive. Now, you will know that there's a big debate, and there are big proponents, and some of them have been on the previous slide, that are very pro-active. and very pro passive, and anything that's active is kind of, the worst thing in the world. And then you have, loud commentators out there that's very proactive, and anything passive is very bad. So you have this very lively debate, and you rarely find somebody that's in the middle, so in the gray area between passive and active. This middle area, there's very few, at least not in the forums, etc. I am in. You're either active or you're passive. Anyway, that's a debate. As I said to you, I really unpack this in the next webinar. Couple of things that I just want to quickly talk to you about. And best of breed and bottom up is what I want to explain with the following example. We used to, in our dealing room, we used to have a bit of fun, believe it or not. And we, I don't know if they still have it on the Sunday papers these days. They probably do. But all the companies on the JSE, it's a lot less these days, but all the companies 10, 15 years ago were, on the back page of the Sunday newspapers. We would put it on a big board, and we would take a dart and throw a dart at the board. That dart obviously hit one of the companies on that newspaper, and that was the dart's pick. And then each of the dealers on the desk also picked a share that they thought would be the best share for the week. All right, so it's a week, so it's hard to measure anyway. But I can tell you the dartboard won a lot of times. And if you win, you would have received I can't remember if it was cash or whatever. The point is, it was a little bit of fun. But when we talk about passive versus active, I think one of the big things that's left out of the conversation is that it's a dart that gets thrown from the active side into a dartboard. It can be anything of these, let's talk equities, any share of the 250 shares that's active on our stock exchange, any of them, and that's what we choose. I think from an active perspective, there's a little bit more thought that goes into active choices than just a dartboard. That's the first thing. The second thing that I just want to mention quickly here, and again, some of these concepts I chat through in more detail in the next webinar. The second thing is, once I've thrown that dart and it hits that share, and that share is Steinhoff, for example, just because we all know the story, it doesn't mean I have to keep that share forever. So it's not the share I hold on to for the next 30 years, or fund, or whatever the underlying instrument is. So those are two things that I want to just make sure when we have the active passive debate, those two components are presented fairly within that debate. Okay, cost versus performance. I would say 6-7 years ago, this was absolutely true. The cost in terms of a active fund versus the cost of a passive fund, they were miles apart. It was very, very expensive to get an active fund. Pencils have been sharpened over the past couple of years. And when you go and look at costs these days, they are a little bit more in line with passive fund. But obviously, you have to get that performance. So if I pay the 40 basis points, 0.4% down here, if I pay 0.4% more, you bet I want performance that's at least beating 0.4%, 40 basis points, whatever that cost component is for active management that I pay extra. And then the last thing kind of ties up into I throw the dart and I keep that instrument for the next forever, is this idea of 40 basis points over many years. Again, We pigeonhole the active then, that argument at least pigeonholes the active management in, or my decision to be involved in active management in this case, for them however many years, 10, 20, or whatever the argument is. It's almost like I'm not allowed to change my mind at some point in time and potentially go more passive or a mixed strategy. But anyway, we'll chat through those topics in the next webinar. Diversification then is you already understand the second bullet point there, the diversification between asset classes. We've already spoken about them: bonds, properties, equities, cash, near cash. There are other ways to diversify. We've spoken a little bit about jurisdictions, and here I'm it's a kind of a net that I'm throwing to say jurisdictions is countries, regions, so we can diversify across jurisdictions. But the other one that we need to understand, I feel importantly, is the style diversification. You have different types of asset managers. Some believe in a value play, deep value. The value versus growth argument is a big argument again these days that you'll see on media. Momentum, mean reversion, and there are other styles as well. The point is, when you bring your asset allocation to me, and you are in a retirement annuity, for example, and whoever assisted you, or you may have done it on your own, doesn't really matter, but has a big asset manager A, 25% of their balance fund, big manager B, 25% of their balance fund, big manager C, 25% of their balance fund, big manager D, 25% of their balance fund. And you've just duplicated 4 strategies, especially when it's the bigger guys, because the investable universe is much smaller because of the size, which is another conversation I'll explain later. But the point is, you've just, whatever the argument is, you've just gone and invested, in 4 different strategies that has the exact same underlying instruments. So that I'm not a fan of at all. However, if you tell me that, big company A is a deep value manager, B momentum, C mean, whatever the underlying style is, then I would say, okay, well, there's a different thought pattern. So we have a diversification across styles. So I don't mind having equity fund A, equity fund B, equity fund C, or whatever, bond balance, doesn't matter what we're talking about, as long as there is at least style diversification. Because if I just buy Naspers in each of these, that doesn't give me any diversification. So style diversification is an important concept that I think you need to consider when you talk about asset allocation. I'm running out of a little bit of time. The last one that I'm just gonna quickly chat through, and I see it's already 1 o'clock, is the cost debate. And understand, I alluded to it a little bit earlier in the active versus passive. The one thing that, and why, the reason I put this slide up here is not because of the active versus passive and how much more expensive active or passive is. That different one, and I'm continuing to talk about that one at the next webinar. There's a specific reason why I threw this slide in there, because just before I put this presentation together the first time, I had a client that came in, and whoever he spoke to threw out 2 or 3 funds due to them being very expensive. And I want you to understand this very quickly. We have a fund manager chart, and don't worry about this mix. It's some of those funds you've seen earlier, and I threw a little bit to make it a little bit of a balanced fund in here. I threw in some resources and bonds and property, whatever, just to give you a bit of a balanced fund view. Don't worry too much about what's in here. It doesn't mean much. I don't think this is a particularly good portfolio even. So don't, don't invest in this as you see it here. It's just for illustrative purposes. What I'm trying to show you is that every investment manager, and I'm going to zoom in on 36.1 BCI equity fund here as an example, because I think it's an important example. They have an asset manager charge of 0.8%. So to pay the analyst, to open the doors every month, to pay the telephones and the salaries and the whatever, this is what kind of it's for, right? So there's a manager charge. So it's 36.1 charges 0.8%. Then there's this thing called, and it came in I think it was 2016 or 2017, where CISA that I referred to earlier forced everybody, for good reason, don't get me wrong, for good reason, to use this concept called TIC, Total Investment Charge. To understand at least this point, what is the total charges? Because the manager charges 1. Then that manager has to execute strategies, and that may have, let's say, they buy equity, so there's commissions, right? So the equities cost money to get into. There are fees, etc. The other one that's included in that list is performance fees. So understand that when you look at a TIC, total investment charge, and then we put all together, it's called EAC, effective annual cost, but don't worry about that now. When you make sure, when you look at something that looks ridiculous, make sure you interrogate why it looks ridiculous. 36.1 BCI equity fund, arguably one of the best equity funds out there. TIC on this very same day was I wrote it down not to get it wrong, 3.24%. Okay, so if you look at a fund manager that has a total TIC, a total investment charge, a cost of 3.24%, you would say that's daylight robbery. I'm probably going to run the other direction. They're busy stealing my money. And you could potentially be right in some instances, but I want you to understand what a TIC or total investment charge means. 36.1 BCI equity fund had a very good couple of years before this point in time. Therefore, included in their TIC, what they should show you as a client is the relative or the potential performance fees again. So if they did, let's say they have a 20% performance fee, calculation. So anything above the benchmark, they take 20% off, and let's say they really did well, and that's 2-3%, which was the case. I think 2.5% or whatever the case was. Then they show that within their normal management fee. So for me to pay a fund manager a performance fee, I have no problem with it personally, because I need to incentivize you to take my money and really make it more than it is today. And by doing that, performance fee is one of the most kind of applicable ways to achieve that goal out there at the moment. So all that I'm trying to get to here is make sure you understand the difference between a management fee, 0.8% in this case, and a total investment charge, 3.24% on this day. And the reason why they may look expensive. Don't just throw out this specific one. For example, if I may continue using this specific equity fund, the 36.1 don't just throw it out because it looks expensive. Please make sure you understand why it looks expensive. And if the reason is because these guys understand the market currently, the jockeys that can ride this horse currently into a winning position, then there's no reason to diss a 3.24% total investment charge. Okay. I'm 5 minutes over. Apologies for that. Next time I'll try and talk a little bit faster, but thank you for joining me. You have our details, please, and if you want to get hold of me directly, Jaco@randswiss.com. send me an email. Happy to engage with you. Thank you for your time. I really appreciate it. Hopefully you learned one or two things. Hopefully it was of value to you, and I hope to see you at the next one, which is the Great Passive Active Debate. Thank you very much.